Walk into a Dollar Tree and pick up a bag of chips, a bottle of dish soap, a phone charger, all under a couple dollars. Multiply that by 10,000 stores and the math stops making sense. This looks like a business that should be losing money on almost everything it sells. It is. That's not a flaw in the plan. That's the plan. And when the balance tips even slightly, it doesn't just dent the profit line. It can erase $9 billion in about a decade. Here's the twist, and it's worth sitting with before we go further. They're not making money on the dollar item in your hand. They're making money on everything happening around it. The real estate underneath it. The store brand sitting one shelf over. The trip you didn't plan to take until you ran out of dish soap. On paper, opening one of these stores looks like the easiest business in retail. No butcher counter, no produce section quietly rotting on a clock, no kitchen, no liquor license, no staff of 12 to manage. Just a small box, some shelving, and a truck that shows up on schedule. Compare that to a restaurant where half the startup capital goes into equipment that starts depreciating before it's paid for itself. A dollar store skips almost all of that friction. The numbers pitched to investors make it look even cleaner. Something like $97,000 in startup capital, a 12-month break-even. That's the kind of figure that gets circled in a business plan and carried into a bank meeting, and the real estate is practically an afterthought, or at least it looks that way. These stores don't need downtown frontage or mall space. They thrive in the leftovers, a strip mall on the edge of a small town, a corner lot nobody else wanted, a rural crossroads too far from the nearest supermarket to be worth a bigger chain's attention. Cheap land, cheap build-out, low rent, retail stripped down to the studs so the dream writes itself. If one store costs next to nothing and breaks even inside a year, why stop at one? Open 1,000, open 10,000. Small enough to slot into towns too small for a Walmart, cheap enough that even a mediocre location still pulls its weight. Stack enough of these boxes together and you stop looking at 10,000 tiny businesses. You're looking at one enormous machine, one that almost nobody bothers competing with, because the margins on any single store look too thin to chase. That's the pitch: small footprint, small cost, small risk multiplied by scale into one of the largest retail footprints in the country. It's a clean story. It's also missing the part where almost everything on the shelf barely makes any money at all. Look at what's actually stocked near the front door. Chips, soda, toilet paper, canned soup, toothpaste. This category is called consumables, and it's the single largest section of inventory in nearly every dollar store in the country. That's not an accident of shelf space. It's the entire reason the doors stay open. Consumables exist to get you inside, not to make money off you, just to get you inside. Nobody drives across town for a discount t-shirt. But people will walk down the block because they ran out of dish soap and don't feel like doing a full grocery run for one item. That small, boring, recurring need is worth more to a dollar store than almost anything else it sells, because it turns the store into a habit instead of a destination. Now look at the actual math sitting behind that habit. Gross margin at a place like Dollar General or Dollar Tree runs around 31.5%, a few points higher even than what Walmart posts on similar goods. So far, this looks healthy. A store keeping close to a third of every dollar in gross profit sounds like it's doing just fine. Here's where that stops sounding fine. 31% is what's left after paying for the product itself. It is not what's left after the delivery truck, the employee stocking the shelf, the electricity, the rent. Once all of that gets subtracted, Dollar General's net profit margin lands around 3.5%. Read that again. 31 turns into 3.5. Almost the entire gross margin gets eaten alive before a single dollar reaches the bottom line. So if the loss leader items aren't the engine, what is? Follow the shelf back from the front door, past the soda and paper towels, and you find the store's actual house brands. Names like Clover Valley, DG Home. Labels built to sound generic, easy to walk past without a second look. These private label products carry meaningfully higher margins than the national brands sitting right next to them. They look cheap. They are cheap. They're also quietly the most profitable thing in the building. The dollar store isn't hiding its real business from you. It's just betting you won't notice, because that business is dressed up to look identical to everything around it. Then there's a layer, that has nothing to do with what's on the shelf. Real estate. A meaningful share of these stores aren't leased, they're owned outright. Dollar General owns roughly 47% of its store properties. One decision, made once per building, then forgotten about, saves the company somewhere around $100 to $150 million a year. No cashier rings that up. No customer ever sees it happen. It just sits underneath the whole operation, quietly outperforming most of what happens at the register. Underneath even that sits the piece almost nobody pictures when they think of a dollar store: the truck network, distribution centers, cold chain logistics for the frozen and refrigerated goods increasingly filling these shelves. Decades of figuring out which corner of which town deserves the next location. None of that is glamorous. All of it is slow and expensive to build, which is the point. It's a moat a competitor can't just decide to copy on a Tuesday. When traffic holds up, that footprint turns into leverage, spreading fixed costs across more sales and pushing profit up faster than revenue. When traffic weakens, that same footprint becomes dead weight, which brings the whole thing back to a fragile balancing act. The store needs consumables to keep people walking in, but consumables are the lowest margin thing it sells. The more a shopper's basket tilts toward toothpaste and canned soup instead of seasonal goods or a discount t-shirt, the worse the math gets, even while the register keeps ringing and total sales keep climbing. A store can look busier than ever and quietly make less money on every visit. That's not hypothetical. It's already shown up in the numbers, as shoppers lean harder into essentials and away from the higher margin goods that used to balance the books. And this is where the machine most often breaks. Not because these stores are badly run. Most of them are run with brutal discipline. It breaks because the whole model depends on two forces pulling in opposite directions, with almost no slack to absorb the difference. The traffic engine is cheap staples: toothpaste, soup, dish soap, the stuff that runs out on a schedule no matter what the economy's doing. The profit engine is private label margin, owned real estate, a logistics network built over decades. Those aren't the same thing, and they don't scale together. The more successful a store is at pulling people in for cheap essentials, the more its sales mix tilts toward the lowest margin category it carries. Success at the front door works against success at the bottom line. Now add the layout. These stores are built small, fast, low friction, narrow aisles, minimal staffing, self-checkout in a lot of locations. That's exactly what keeps the cost of running each store low enough for that $97,000 pitch to make sense. It's also exactly the kind of environment where things go missing. Fewer employees, fewer eyes, fast in and out shopping, less friction for someone walking out without paying. The same choices that make the store cheap to run make it easier to steal from. And shrink hits differently here than almost anywhere else in retail. In a business running healthy double-digit margins, losing $100 of inventory is a bruise. In a business with a net margin around 3 or 4%, that same $100 can require something close to $500 in additional sales just to break even on the loss. Thinner margin, more damage from the identical dollar of theft, and dollar stores run some of the thinnest net margins in all of retail. This isn't a story stitched together after the fact either. In one recent quarter, Dollar Tree's gross margin fell by more than 2 full percentage points, and executives pointed to two things happening at once: rising shrink and customers shifting further into low-margin consumables. Two symptoms, same mechanism, same quarter. It'd be easy to file this under overhead is high and move on. But that explanation could describe almost any struggling retailer, and it misses what's actually happening. This isn't costs quietly creeping up in the background. It's the two things a dollar store needs most: cheap staples to keep people coming in, a layout cheap enough to make the format work at all, quietly working against the one thing it needs to survive, which is margin. A supermarket chasing traffic and a supermarket chasing profit are usually chasing the same goal. A dollar store chasing traffic and a dollar store chasing profit are, past a certain point, pulling in opposite directions. If you want to see that imbalance stop being theoretical, you don't have to look far. In July of 2015, Dollar Tree closed a deal to buy Family Dollar for $8.5 billion. On paper, it was a merger of two companies built on the same idea: joining forces to challenge Dollar General at scale. Family Dollar brought roughly 7,000 stores to the table. It looked, at the time, like the obvious next move for an industry built entirely on scale. It didn't work. For nearly a decade, Dollar Tree tried folding Family Dollar into its operations, and for nearly a decade, the two chains never quite became one functioning machine. Supply chains that were supposed to merge stayed separate. Locations that were supposed to benefit from shared logistics turned out, in plenty of cases, to be poorly placed to begin with. The operational discipline that makes this whole model work, tight cost control, careful site selection, a supply chain built for wafer-thin margins, never fully transferred from one company to the other. Then fiscal 2023 arrived, and the numbers stopped being quiet about it. The combined company posted a net loss of $1.7 billion for the year. Buried inside, $594 million for a portfolio review, $1.07 billion in goodwill impairment, $950 million in trade name impairment. That last figure means Dollar Tree looked at the Family Dollar name itself and admitted, on paper, it was worth nearly $1 billion less than they'd claimed the year before. The response was to shrink. Dollar Tree announced plans to close around 1,000 stores across both brands, warning investors it could lose $730 million in annual sales, but that closing the underperforming locations would still add 30 cents a share to earnings. Sit with that trade-off for a second. It was cheaper to walk away from $750 million in sales than to keep those stores running as they were. And then came the number that ends the story. The chain Dollar Tree, paid roughly $9 billion for in 2015, sold for about $1 billion in 2025. Not to a rival looking to expand, to private equity buying a distressed asset at a steep discount. A global data analyst summed up what happened in about as few words as it takes to describe a $9 billion mistake. Dollar Tree, he said, basically bit off more than it could chew. It's worth being precise about what actually broke here, because this isn't a story about dollar stores failing as an idea. Dollar General, running the same basic model over the same stretch of years, stayed profitable the whole time. The difference wasn't the concept. It was execution, the site selection, the supply chain, the operational discipline that has to stay razor tight for a business running on 3 or 4% net margins to survive at all. Family Dollar's stores were, by multiple accounts, often poorly located and expensive to fold into a supply chain that never fully merged with Dollar Tree's own. The same fragile balance we've been tracing this whole time. Cheap enough to draw people in, profitable enough to keep the doors open, tipped the wrong way, at scale, across thousands of stores for the better part of a decade. And once it tips at that size, there's no shrink number or cost-cutting plan that pulls it back. There's only the sale. So who actually wins in this model? Not the customer holding the dollar item, not always the company whose name is on the sign either. The real winner is whoever controls the ground the store sits on, owning close to half your real estate outright, the way Dollar General does, is worth more over a decade than almost any single merchandising decision the company ever makes. The building becomes the asset nobody else has to compete for. The second winner is the private label. Those quiet, generic-sounding house brands sitting one shelf over from the name brands do more work for the bottom line than the entire consumables aisle combined. They don't announce themselves. They don't need to. And the third winner, oddly enough, is discipline itself. Not a person, not a company, just the willingness to keep two mismatched engines running in balance. Cheap enough to pull people through the door, profitable enough to survive the trip. Dollar General held that balance for decades. Dollar Tree, for one very expensive stretch, did not. That's really the whole difference between the best case and the worst case here. Best case, a chain treats its cheap image as a tool rather than an identity. It owns its land. It protects its private label margin. It keeps a tight leash on shrink and grows slowly enough that its supply chain never outruns its discipline. What comes out the other side is one of the most boring, most reliable profit machines in retail, quietly making money for 50 years without anyone outside a boardroom ever noticing how. Worst case, a chain starts believing its own pitch. It grows too fast, buys the wrong company, Let's consumables crowd out the categories that were actually paying the bills, and let's shrink creep in, because nobody's watching the door closely enough anymore. That imbalance doesn't announce itself either. Not until the write-downs start, and by then it isn't a correction anymore. It's a fire sale. So next time you walk out of one of these stores holding a dollar bag of chips, think about what you actually bought. It was never the chips. The dollar store was never really selling you something cheap. It was selling itself something far more valuable. The 15 seconds it takes you to walk through the door. And the day one company forgot the difference. That mistake cost it $9 billion to learn.